The Federal Reserve just dropped a bombshell, and the White House is not happy about it. In the last 48 hours, the new Fed chair made a statement so direct, so blunt, and so politically charged that it is being called one of the most defiant moves by a central bank chief in modern American history. And if you think this is just another boring economic news story, stay right here. Because what happens next could affect your job, your savings, your mortgage, and the price of everything you buy at the grocery store. This is not a drill. This is happening right now, and you need to understand exactly what was said, why it matters, and what it means for your wallet starting today. Before we go any further, if you are new here, hit that subscribe button right now and tap the like button, because we cover the stories that actually impact your real life, your money, and your future, and we break them down in plain English so anyone can understand. Now let us get into this, because the clock is ticking and the pressure is building in Washington like we have never seen before. So here is where we are. The United States has a new Federal Reserve chair, and from the very first major public address, this person made it crystal clear that the Fed is not going to bend to political pressure. Not from Congress, not from the media, and certainly not from the President of the United States. The statement that sent shockwaves through Washington was simple, but absolutely loaded. The Fed chair stood in front of cameras and microphones and said, in no uncertain terms, that interest rates will not be cut simply because someone in power wants them cut. The decision to lower rates, hold rates, or raise rates will be based on data, on economic indicators, on inflation numbers, and on the long-term health of the American economy, period. No political timeline, no election cycle consideration, no pressure from the Oval Office will change that. Now, if you are wondering why that is such a big deal, let us back up and explain exactly what has been going on between the Trump administration and the Federal Reserve. Because this tension did not start yesterday. It has been building for months, and it has now reached a boiling point that could reshape the American economy for years to come. President Trump has been very vocal, very public, and very aggressive in his demand that the Federal Reserve cut interest rates. He has said it in speeches, he has posted about it on social media, he has brought it up in press conferences, and his economic advisors have echoed the same message over and over again. The argument from the Trump camp is straightforward. Lower interest rates mean cheaper borrowing. Cheaper borrowing means businesses invest more, consumers spend more, and the economy grows faster. On the surface, that sounds pretty logical, right? And there is some economic theory that supports that view under the right conditions. But here is where it gets complicated, and here is where the new Fed chair is drawing a hard line in the sand. The Federal Reserve does not just look at whether the economy is growing, it looks at whether the economy is growing in a healthy, sustainable way. And right now, the data is sending some very uncomfortable signals. Inflation, while it has come down from the historic highs we saw a few years ago, is still not back to the Fed's target of 2%. Certain categories of consumer goods are still stubbornly expensive. Housing costs remain elevated in most major American cities, and the labor market, while still relatively strong, is showing early signs of cooling in ways that make some economists nervous. The Fed chair laid all of this out in a presentation that was almost deliberately calm and measured, which somehow made it feel even more defiant. There was no panic, no apology, no hedge, just facts, data, and a clear message. We will not cut rates until the numbers tell us it is safe to do so. And that message landed like a grenade inside the Trump White House. Sources close to the administration have described the reaction as furious. Advisors who have been pushing for rate cuts as a way to juice the economy and deliver a win heading into the political cycle are now scrambling. Some insiders are reportedly floating the idea of exploring whether the president has any legal authority to influence or even remove the Fed chair, a question that opens up a constitutional can of worms that no administration has seriously had to deal with in decades. And that right there tells you everything you need to know about how serious this standoff has become. Now let us talk about what this actually means for you, the person watching this video right now, because this is not just a fight between powerful people in expensive suits in Washington. This fight has real consequences for real Americans, and they are consequences that are already starting to show up in your daily life. If you have a mortgage or you are trying to buy a home, you already know that interest rates are a massive factor. Higher rates mean higher monthly payments. They mean you either pay more every month, buy a smaller home, or wait. And millions of Americans right now are in that waiting position, frozen out of the housing market by rates that have made homeownership feel out of reach. The Fed's decision to hold rates is directly connected to that reality. Every month the Fed holds, that is another month where the dream of owning a home gets pushed further away for families across this country. If you have credit card debt, and statistically speaking, most American households do, higher interest rates mean you are paying more in interest charges every single billing cycle. The average American household carrying credit card debt is paying hundreds of dollars more per year in interest compared to just 3 years ago. That is money that is not going toward groceries, school supplies, car repairs, or savings. It is going straight to the banks. And while the Fed holding rates steady does not make that worse than it already is, it absolutely does not make it better. If you own a small business or you are thinking about starting one, access to capital is everything. Loans, lines of credit, business financing, all of it is more expensive when rates are high. And that means fewer businesses are expanding, fewer people are being hired, and the entrepreneurial engine that drives so much of American economic life is running at reduced capacity. The business community has been split on this issue. Some large corporations with access to bond markets and alternative financing are less affected. But your local restaurant owner, your neighborhood contractor, your small manufacturing shop, those people are feeling the squeeze every single day. Now here is where the story gets even more layered, because it is not just about the domestic economy. This standoff between the Trump administration and the new Fed chair is being watched very closely by international markets, by foreign governments, and by global investors. And what they are seeing is something that is making some of them nervous and others opportunistic. The independence of the Federal Reserve is considered one of the foundational pillars of trust in the United States financial system. When foreign governments and international investors put money into American markets, when they buy US Treasury bonds, when they hold US dollars as reserve currency, part of what they are buying into is the belief that American monetary policy is run by professionals who make decisions based on economics, not politics. The moment that belief starts to crack, even a little bit, the consequences can be enormous. We are talking about capital flight, about the dollar weakening, about borrowing costs rising not just for consumers, but for the United States government itself. And if the cost of financing the national debt goes up, that is a problem that eventually lands on every single taxpayer in this country. So when the new Fed chair stands up and says, "We are independent, we follow the data, no one tells us what to do," that is not just a domestic political statement. That is a message to the entire world that America's financial institutions still operate on principle and not on political convenience. And that message is incredibly important right now, given everything else that is going on in global markets. But let us be honest, because this situation has two legitimate sides, and good journalism requires us to look at both of them. The Trump administration's argument is not completely without merit. There are serious economists, not fringe voices but respected academic and institutional economists, who believe that the Fed has been too slow to ease monetary policy. They argue that inflation is close enough to the target that the risk of cutting rates is manageable, and that the greater danger right now is choking off economic growth by keeping rates too high for too long. They point to the historical record and note that the Fed has made mistakes before, sometimes keeping rates too tight and causing unnecessary economic pain. And they argue that political accountability matters, that elected officials should have some legitimate input into decisions that affect every American's financial life. These are not crazy arguments. They deserve to be taken seriously. And the fact that the Trump administration is pushing back on the Fed is not inherently wrong. Presidents and Fed chairs have had disagreements before. It is part of the system. What is different this time? What has elevated this particular conflict to a new level of intensity is the rhetoric, the public pressure, and the reported discussions about whether executive power can be used to override or restructure Fed leadership. That is the line that most economists and financial experts say cannot be crossed without serious long-term damage to American economic credibility. And here is the thing that does not get talked about enough in most news coverage of this story. The Federal Reserve Chair is not some faceless bureaucrat operating in a vacuum. This person was nominated, vetted, and confirmed through a process that is designed specifically to create a buffer between monetary policy and the short-term pressures of electoral politics. That is not an accident. That is a feature, not a bug, of the American financial system. It was designed that way precisely because history has shown, in the United States and in other countries, that when monetary policy gets captured by political interests, bad things happen. Inflation spirals, currencies collapse, recessions deepen. The whole point of an independent central bank is to take that decision-making out of the hands of people who are thinking about the next election and put it in the hands of people who are thinking about the next decade. So what happens next? That is the question everyone in Washington and on Wall Street is trying to answer right now, and the honest answer is that nobody knows for certain. But here are the most likely scenarios, based on what economists and political analysts are tracking. Scenario 1 is that the standoff continues. The Fed holds rates, the White House keeps pushing publicly, and the tension becomes a kind of background noise that the markets learn to live with. In this scenario, we probably see some continued volatility in stock prices, some pressure on the dollar, and a lot of very loud political noise, but no fundamental rupture. This is actually the most likely scenario in the near term, simply because changing Fed leadership or restructuring the institution requires congressional action, and that is a complicated and time-consuming process. Scenario 2 is that the economic data shifts enough that the Fed decides on its own to cut rates, not because of political pressure, but because inflation comes down further and the labor market softens enough that the math supports easing. In this scenario, the White House claims victory. The Fed says it was just following the data, and everyone moves on. This scenario is possible, but depends on economic conditions that are not entirely within anyone's control. Scenario 3 is the one that keeps financial experts up at night. This is the scenario where the conflict escalates to the point where there is a genuine attempt to remove or replace the Fed chair, or to pass legislation that would change the Fed's mandate or structure. This scenario would likely trigger a massive market reaction, potentially a significant sell-off, a weakening of the dollar, and a crisis of confidence in American institutions that could take years to repair. Most analysts consider this unlikely in the short term, but the fact that it is being discussed at all is itself a significant signal. And then there is a fourth scenario that most mainstream coverage ignores, and that is the possibility that the rest of the world quietly starts to diversify away from dollar-denominated assets, regardless of what happens in Washington. Some of this is already happening. Countries that have been looking for reasons to reduce their dependence on the US dollar as the global reserve currency are watching this fight between the White House and the Fed very carefully. And every escalation gives them more ammunition to argue that the dollar system is becoming politically unstable. This is a slow-moving trend, not an overnight collapse, but it is real, and it has real long-term implications for American economic power. Here is the bottom line that you need to take away from all of this. We are living through a moment where the foundational architecture of American economic policy is being tested in real time. The institutions that have been taken for granted for decades are showing their fault lines. And while it is easy to get caught up in the political drama, the personalities, the tweets and the press conferences, and the behind-the-scenes fury, what actually matters is the downstream effect on your life, your mortgage, your credit card rate, your small business, your retirement savings, your grocery bill. All of these things are connected, directly or indirectly, to the decisions being made right now in those rooms in Washington. The new Fed chair has drawn a line. The Trump administration has made clear it does not like where that line is drawn. And the rest of us are sitting here watching, wondering which way this is going to break, and preparing ourselves for the consequences of whatever comes next. What you can do right now, and this is not financial advice, talk to a financial advisor about your own situation, but generally speaking, this is a time to be paying attention. If you have variable rate debt, it is worth understanding what your exposure is. If you are in the housing market or planning to be, watch the economic data that the Fed watches, because that data will tell you more about where rates are going than any political speech will. If you have investments, understand that periods of institutional tension like this one tend to create volatility. And volatility can be an opportunity or a danger depending on your position and your timeline. And if you want to stay ahead of stories like this one, stories that the mainstream media often buries under celebrity gossip and political theater, stories that actually affect your real life and your real money, then you know what to do. Make sure you are subscribed, hit that notification bell so you never miss an update, and drop a comment below right now telling us what you think. Do you think the Fed chair is right to hold the line on rates? Or do you think Trump has a point that rate cuts would help everyday Americans? This is a genuinely complex debate, and we want to hear where you stand. Share this video with someone who needs to understand what is happening with the economy right now, because most people have no idea how directly this story connects to their everyday financial reality. The more people understand, the better equipped we all are to navigate what is coming. Stay informed, stay sharp, and we will see you in the next one.